But our next guest says, be careful what you wish for. Let's bring in Rich Bernstein. He's the CEO and Chief Investment Officer at Bernstein Advisors. What do you mean by that, Rich? Welcome.
Well, Kelly, good to see you. Welcome back. I think, I think people have forgotten why the Fed cuts rates to begin with and how the Fed is the central bank. And, when they cut rates, they do so to lower the cost of funding to the banking system because the banking system isn't lending. And the Fed hopes that by cutting rates, lending will pick up, and they hope in turn that that pickup in lending will stimulate the economy. So the question we should all be asking right now is, where's the hiccup in the financial sector that is stymieing lending, which in turn is stymieing growth? And I think you'd be very hard pressed to find that right now.
Are high rates themselves the stymie? I've heard others, I think if I'm saying it correctly, Barry Knapp's case on this is that they should have cut much more a long time ago. And that's why we're resulting in this K-shaped economy where money is too expensive kind of for the broad consumers out there, broad lending. And it's really only because of the strong stock market that people have done well.
Well, Kelly, look, if the K-shaped economy is a reality, and I get that, and I'm not being cold at all. Please don't misunderstand what I'm about to say. But lower rates will not encourage lending to riskier entities if rates come down. If their cost of funding comes down, they will keep lending rates the same to entities that are riskier. To automatically assume that rates throughout the economy will come down, that just doesn't make any sense. We already have credit spreads about the most narrow in my career. How much more narrow are they going to get? So that's an issue for the fiscal side more than the monetary side, which of course nobody wants to talk about these days because of the deficit and everything else. But realistically, the Fed is very limited in what they can actually do. And the question, look, even today, your big story today is about a big merger. Are those entities having any trouble getting financing for this merger?
Right,
No.
but that's exactly the point, is that, big business, those who are using corporate bond markets, they're all doing, they have cheaper capital, that's fine. But what about those who are relying, people say, look at the people falling behind on car loans or the cost of car loans. Obviously, the mortgage is the big one hanging out there. So in that sense, I think you and I would agree that the goal is to bring those rates down. But it seems like rate cuts right now, I don't know why the bond market is kind of puking this week the choice of words.
Yeah, but you see, the risk is, Kelly, that if you just lower rates and there's no hiccup in the financial sector, that ultimately that spurs inflation, right? You get the misallocation of capital, the hurdle rates in the economy are too low, and you get this misappropriation of capital in the economy. We could argue that that's actually happening already, right? When you think about the K-shaped economy, maybe the investment isn't going where it's supposed to be. I'm not sure lowering rates is going to encourage lending to riskier entities that's going to close that K-shape. I don't think that's the way you want to handle this. I think that's a fiscal issue, not a monetary issue.
I appreciate the 2 cents because, obviously this is the debate of the week. And I'm curious how this fits in with your overall view on the markets, Rich. A lot of people have come out with very bullish price targets for next year. Bottoms up earnings estimates of 13%, and rising. So It's looking positive, and even like we could get some broadening. But I note that you're kind of saying maybe it's time to stick with boring. Consumer staples are down for the third year in four, so I don't know if you'd go there. But that you're saying maybe next year is a year to go with more of the boring parts of the market.
Right. I think our theme for 2026 is boring is beautiful. And it's not a bearish comment. These days, if you're not the biggest bull on the Mag 7, everybody says you're bearish. And I'm not sure I understand that, because if you like 493 stocks and you don't like 7, why are you so bearish? That doesn't make any sense to me. Rather, what we're saying is that there's a broad spectrum out there of opportunities. What's boring? How many people come on your show these days and talk about dividends? Probably not very many. But dividends are one of the key parts to building wealth through time. The compounding of dividends is amazingly important.
Reinvest
when you get speculative kind of heady periods like we're in right now, people forget that. Non-U.S. quality, Kelly, I think is the biggest bargain out there. It's now got a growth rate that is faster than that of the Mag 7. Faster than the Mag 7.
Non-U.S.
7 to 8
quality.
times the dividend yield,
Any names,
and 30 to 40% cheaper.
Are those